Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team.
We're going to start off this morning with Bob giving us an overview of what's happened over the first 3 quarters, and then also get into what we're seeing in real time and even in the last 30 to 60 days of some changes that we've seen on a lot of the activity transactions that we're currently marketing. And then we're also going to get into some questions that we've received from you about some big picture items, fundamentals, lending and interest rates, and a number of those legislative issues that we're all constantly talking about. So without further ado, I'd like to introduce Bob Knakal.
Thanks, Hags. Thanks, Hags. Good morning, everybody. For those of you who don't know, that was John Hageman, who is my right-hand man, my wingman. He has run my team for 14 years. And if you don't know Hags, get to know him. He's a terrific real estate guy, and the success of myself and my team wouldn't be what it is without his efforts. So Hags, thanks for being here. We're going to do a little fireside chat later. But I thought what we'd start off with today is to go over what we're seeing in the marketplace. And I think that indicative of what's happening in the market today, this is the biggest turnout we've had for one of our chats. And I think it's mainly because everybody, including us, trying to figure out what the heck is going on in the world. There's a lot of signals that are mixed, a lot of things we're trying to figure out, but there's a lot of noise in the marketplace, and hopefully we'll give a little bit of clarity to what you're seeing out there. But anyway, in terms of where the market is, you know, we always look at what we call the 2 V's, volume and value. And these arrows have looked this way for about 3 years now. In terms of the volume of sales, in the dollar volume and the number of properties sold, those have been on the downswing, while value on average is still going up. And these conditions are quintessentially what you see when a market is in correction mode, when a market is changing. And you know, often people say, well, where are we in the cycle? Why is this cycle lasting so long? Are we in the late innings? What's happening? It's been our opinion that we're in a whole new game, and that new game started in the beginning of the 4th quarter of 2015. And we've been in correction mode for about 25 months now. Now, albeit that correction has impacted different product types differently. Some have lost value, others have held their value. But the fact is that these arrows have looked this way for a while and probably will look this way for at least another 2 or 3 quarters. But let's get into the numbers and see where we are. We have our 3rd quarter stats completed, and we can go through what we're seeing. In terms of number of properties sold, and we look at dollar volume, we look at number of properties sold. I always maintain that the number of properties sold is more indicative of activity in the market, because in New York City, very, very large transactions can skew dollar volume very significantly. But if you look at number of properties sold, you see this year we're tracking towards about 3,700 sales. It feels really worse than it is. We're down 15% from last year and down 33% from the peak in 2014. 2014 was an all-time record, more buildings sold in 2014 than any other year in history by more than 10%. But if you look at this, you know, this is now the 3rd year in a row where we'll have a muted number of properties sold, but yet the long-term average for the city is about 3,600 sales. So we're still above average, which means a couple of things. One, it's not as bad as we feel it is, but number 2, the number of properties sold could drop very significantly to maintain that average. And if we think about what that could be like, that really isn't pleasant to think about. But you know, the fact is, number of properties sold is trending downward. And if we look at how Manhattan is relative to the outer boroughs, there's a big disparity there. And we always say that what happens in New York City will happen in Manhattan first, and then it goes into the outer boroughs. If we take a look here, we see that in the outer boroughs, volume is down also. We're trending about 32% below peak, but in Manhattan, the number of properties sold is down 45%. Now, the interesting thing is that number of properties sold has not been negatively as impacted as the dollar volume has. And if we look, we're going to get to dollar volume in a second, but what we've done here is we've taken a look at number of properties sold on a quarterly basis and compared it to the long-term average. For New York City, the average quarter in New York City has about 954 sales. That 954 is the baseline 0%, and we see on a quarterly basis the green bars are a positive deviation, the red bars are a negative deviation, and you see that big spike we had in 2012. That's important because that was impacted by tax policy. At the end of the year, everybody was anticipating that capital gains taxes were going to increase. We were in a midterm election year. Every politician was talking about how capital gains taxes should be raised. Obamacare had a 3.8% capital gains tax embedded in it. And so there was a ton of selling, particularly in Manhattan, in the fourth quarter of 12. But you see these deviations, and you see the last few years, the last few quarters, we've had some negative deviations. And if we look at Manhattan, you see we have 6 of the last 7 quarters have been below average. That's the most negative of these variances that we'll see. If we look at the outer boroughs combined, we see it's a little less significantly impacted to the downside. Northern Manhattan has had 5 out of 8 in terms of being below average. Brooklyn, 3 quarters down. Queens has been a little bit more balanced. Bronx has not had a negative quarter relative to the average. Activity has been relatively stronger there, and I think that's a push towards investors looking for yield, going to the Bronx, looking for that extra yield. Now, if we get into dollar volume, you start to see these very, very big deviances, differentiation between where we are now compared to where we were. 2015, all-time record, over $80 billion of sales. We're down 57% this year, tracking to about $32.7 billion. Interesting, if you look, we're right about where we were in 2005, and given what's happened with pricing since that time, it's really significant that that we're tracking only to $32.7 billion. If the same basket of properties that sold in 2005 sold this year, the dollar volume would be significantly higher. And gang, we have, for those of you standing in the back, we have seats down front if you want to come down or wherever you're comfortable. If we look at the comparison, same comparison we did last time, looking at the outer boroughs compared to Manhattan, you see in the outer boroughs, dollar volume is down 26%, in Manhattan down 70%. And a big reason for that is that the very larger transactions are not happening with the same frequency that they've happened in the past. A number of folks who have put very large assets on the market have opted to refinance rather than to sell them, and so that's having a very negative impact on our dollar volume stats. If we look at the dollar volume and see how the different submarkets have done over the past year, we see that the Bronx has had the least impact in terms of dollar volume. We're tracking to over $2 billion in sales there, down only about 15.5%, while in Manhattan, we see we're down over 50% in terms of dollar volume. And again, larger transactions are a big reason, or the lack of larger transactions, why that number is as large as it is. If we look at average price per square foot, now getting into value, we're up about 5% this year. That's a new all-time record of $560 per square foot. Again, that's a blend of all property types. And again, there's been negative pressure on fundamentals. There's been negative pressure on residential rents, retail rents, office rents, upward pressure on cap rates, but yet dollar per square foot is going up. And again, this is something that we see when a market is transitioning, because the reason volume falls and value goes up is that sellers who put their property on the market and are able to get their price will transact. If they don't get their price, they don't transact, which is why value appears to be going up, but volume is down significantly. It's because many sellers are not able to get their price and they're simply not transacting. If we look at the comparison of the outer boroughs to Manhattan, we see the outer boroughs are performing much better, with 7.3% increase in value tracking so far this year versus 1.2% in Manhattan. Interesting thing about this graph is that if you look at the shape of the curve in Manhattan, we're convex. That indicates a plateauing of prices, where in the outer boroughs we're still concave. We seem to be going up. So the fundamentals in the outer boroughs seem to be a little better than we have in Manhattan now, but it's important to remember what happens in the city will happen in Manhattan first, which will foreshadow negative implications for the outer boroughs. Now, that being said, if we look again, we see there's a huge disparity between the average price per square foot in Manhattan versus the outer boroughs. That's a huge difference between $1,467 and $400 a foot, but the appreciation rate is very, very different. If we look at average prices per square foot and see where we are year over year, we see northern Manhattan has had the biggest increase in value of over 14%, while Manhattan has had the smallest increase in value. Most markets troughed in 2010. We did have Brooklyn that hit its low point in 2009. But if you had the courage to invest at the bottom of the market when investors were very scared, if you invested in northern Manhattan, on average, your value went up 176% since then. Really remarkable increase in value in northern Manhattan. We've also seen triple-digit increases from Manhattan, Brooklyn, and the Bronx. Queens market has been more muted, a 52% increase in value. I think a big reason for that is there's a lot less new construction in Queens, with the exception of Long Island City, than the other marketplaces that we've seen. We look at average cap rates. We see that citywide, cap rates are about flat. They're up only a couple of basis points. And again, Manhattan versus the outer boroughs, cap rates still essentially flat, compressing 1 basis point this year in the outer boroughs, whereas a 14 basis point increase in the Manhattan market. So generally what we're seeing is that there seems to be, albeit these numbers are down and volume numbers are down, we believe that there is a new optimism in the market. And I've said we're about 25 months into this correcting market. We think that we're going to be coming out of this correction relatively soon. And if you've heard me speak over the last couple of years, I've been very bearish. We saw these reductions in volume coming. We saw the biggest sign that we were going to have a correcting market happened at the end of the third quarter in 2015, when land in New York City dropped in value by about 15 to 20% within a 3-week period.